Lesson 1. The role and responsibility of a senior financial executive. In this lesson, we will look at 4 key areas. We will start then with the role of the senior finance management executive. We'll consider then their key areas of responsibility. We'll look at then how they put together strategies to achieve the objectives of the business. And finally then we'll think about the implications of behavioural finance. Part 1. The role of a senior finance management executive. The role of the executive then will vary depending upon the type of organisation that we'll think about. Their role will consider many different areas, but one of the things then that we will focus on is the way then that the financial strategy of the company allows it to achieve its objectives. There are a very wide range of different organisations, but we will mainly concentrate then on 3 main types of organisation. And these are the ones then that you're likely to see in the exam. The most common one then is a privately owned company. These then are owned by shareholders, and they could be either publicly or privately owned. They will be managed then by a number of different executives then that will sit on their board. We'll also look at then state-owned or public sector organisations. So these are generally then owned by the government of that country. They will also then be run by a board of managers. But one of the things that they will need to think about then is the different political influences of politicians on the organisation. The final organisation then that we will consider is a charity. So a charity then would be run by a board of trustees, and then the assets of the charity are held in a trust by the trustees. And this is the least likely one to be looked at when it comes to the exam. So what is the primary objective then of a kind of profit-making company? Well, the main objective here then is to maximise the wealth of shareholders. We should really do everything in our power as a senior financial executive here to make the shareholders, the company owners, richer. There are 2 key ways then that we can increase the wealth of the shareholders. We can increase the share price, but we can also then pay dividends to those shareholders. And we'll need to keep coming back to this idea of shareholder wealth. All of our financial strategies should come back to this. Organisations, though, will have many secondary objectives that we're perhaps a little bit more familiar with. They will want to increase their sales and revenues there. They'll want to grow their profits and their margins. But crucially, these aren't always linked to shareholder wealth. They might look to expand their market share there and take it from their competitors. They'll want to ensure then that their products are market leaders and that their services are of the highest quality. And they'll want to continue then to develop and build the company's brand, so it's well respected within the marketplace there. So how do we go about then achieving this objective of maximising the wealth of shareholders? Well, we'll need a number of objectives, and we'll need to think about then how decisions are made in our organisation to achieve these objectives. Now, the starting point for any kind of company is to start with what we call a mission statement. A statement really all about the purpose of our company. But this will be very general. What we'll need to do then is break it down. So we'll then break that down into a number of quite wide-ranging goals. These will be quite few in number here, perhaps 5, 6, something like that. Then we'll really start to get much more specific. Okay, we'll break then those quite broad goals then down into some very specific objectives. And within those objectives then, we will have targets that we want to achieve. Then we'll need to think about how we're going to go about achieving those objectives and targets. Well, we'll need to put together then key strategies and develop these amongst the senior financial executives there. These really then map out a route from where we are at the minute to where we want to get to. And where we want to get to then are the targets that we want to achieve. It will then be the role of the senior finance management objectives to come up with those strategies and to make the crucial decisions. Now, in an ideal world, we would want to do everything in our power here to make shareholders as rich as we possibly could, to increase their wealth there. But every business, every organisation here faces resource constraints there on a number of fronts. So capital is never unlimited. There is always a limit then to the capital that is available from our investors or perhaps is generated internally. So we need to make the best use of this capital that we possibly can. Time will also be restricted. Senior financial management executives will only have so much time in their working day there. They might work long hours, but again, there will always be a limit there. So we need to ensure then that they make the best use of that time. Finally, there might be some activities which on the face of it would look to increase the wealth of shareholders, but they might be seen then as unethical, such as perhaps using child labour there or admitting pollution. So we would step away from these activities as we would worry that they would harm shareholder wealth, perhaps over the longer term. So how do we ensure then that these objectives are achievable? Well, one way then is to ensure then that objectives are what we call SMART. Okay, and this acronym then, SMART, stands for an objective then that is specific, it is measurable, it's achievable, it's realistic, and it's timely. And whenever we're setting objectives, we should ensure then that these 5 criteria are fulfilled. Now, objectives then will be broken down further into what we call then key performance indicators, KPIs. Now, the achievement of these KPIs will then indicate then that we've actually hit that objective. So an objective then might be to increase our profits, but actually to break it down into a KPI, we would say we would need to achieve a profit margin of 10% in a specific year. And you can see then that this ticks off the criteria of SMART. We've got a time period there, so it's timely, it's very specific, we can measure it, we've got a number there. Companies also have then a number of secondary objectives. Okay, so these are additional performance measures. Our main one is to maximise the wealth of shareholders, as we've mentioned previously. Whilst the secondary objectives don't measure this directly, we'll find then that they would be very, very closely related to that main aim. So how do companies then really kind of go about setting these goals? Well, lots of companies then will put together what they call a policy framework. This is a policy then that's written and held at the company that helps them then come up with their goals and how then they actually make the decisions to come up with those strategies. So here then we'll have, clear lines around how decisions are made, who makes the decision, what criteria would we look at, what evidence there would we gather. And the coverage here could be on a wide range then of different areas. Many companies will want to ensure then that their future is maintained through sustainable development there. They'll want to ensure then that their company is run correctly and follows the right corporate governance rules, that the company is ethical, and it provides protection then for a range of shareholders and stakeholders, from our most important, the shareholder, through to employees and management there. Now, the objectives of state-owned enterprises and charities, public sector organisations, are very different to those in the kind of private sector there. So these types of organisations might include a hospital that undertakes healthcare here, perhaps organisations in the education industry there, such as schools and universities there, or charities, not-for-profit organisations such as Greenpeace there, or Oxfam. Now, with these organisations then, they will have a very diverse range of objectives. They won't have that single objective of maximising the wealth of shareholders. So, for example, in healthcare, we might have an objective here to improve the health outcomes of cancer patients. In schools then, we might want to improve the ability there of children and their reading. A charity then for the elderly might want to reduce poverty rates for that group. Another charity then that looks at teenagers might do research into the mental health of teenagers, again looking to improve that mental health. So how do we go about then assessing really the achievement of the objectives of these organisations? Well, we use a technique then known as value for money, and this is particularly useful then in state-owned enterprises and charities. All of these organisations then will have a very limited amount of resources, and they need to get the best use out of those resources they can. The three factors then of value for money are known as the 3 E's. We have the economy, we have the efficiency, and we have the effectiveness. So starting then with the economy first. The economy then is concerned with getting the right inputs in there, but trying to reduce the cost of those as far as we can, but still maintaining the quality that we need for the level of output that we want to achieve in terms of our objectives. Efficiency then really kind of matches up the inputs with the outputs here. So this then is concerned with ensuring then that we maximise what we get out, our outputs, from those inputs that go in. So these might be, kind of raw materials that go in here. This might be resources in terms of staff. These would be our input, our economy here. So here then we're looking at how the best use of those is that we can do. The final stage then is effectiveness. This is really then kind of what we get out of the process and ensuring then that we're achieving those goals. So, have we achieved that goal then of improving healthcare there for cancer patients? Have we achieved that goal then of improving the reading ability of school children?